fooled, and you'll soon find out why. So, spend now, pay later. That was this week's quote, and that was from Helen Miller, who's the chief exec for the Institute of Fiscal Studies. Nicely framed there by the most widely well thought of think tank about economics in the country, and massively active around budget week, of course. That's a little tip for you, tilting towards the deep dive as usual. I'm going to look at the budget summary from a couple of the major think tanks, including the IFS, now that we've finally got that clarity we were waiting for. But before we get cracking, as the calendar creeps towards a new year, it's a natural time for us to pause and tackle the biggest challenges that keep SME property businesses from achieving true sustainable growth. For most, this boils down to two core areas. Number one is laying a bulletproof strategic plan down for the next 12 months, and then finally cracking the code on financial measurement and accountability. If you've ever felt lost in a sea of bookkeeping data, or your productivity methods are falling short, you need to switch from doing to leading and truly understanding how your assets are performing. So book in on the next property business workshop with myself and Rod Turner. It's Thursday the 22nd of January. It's at a venue in central London, and it's the link is in the show notes, but it's tinyurl.com/PBWNINE. Now this week I've changed the stylistics a little bit, because a few weeks back I ran with a supplement that was only curated by me but all AI generated. I didn't really like it that much, but I thought I'd better put it out there and see what everybody else thought. Feedback was pretty much mixed. It was probably fair to say there was no way I was getting away without putting all the effort in week to week. But if you've never heard me say this before, one of the reasons why I do the supplement week in, week out is because I actively want to do the work. I need to know in my group, where we've got a sizable balance sheet and, even more importantly, a sizable amount of debt that we owe the bank, that I know what I'm talking about apart from anything else. So there was some positive feedback, however, when I did do that, mostly about structure, headings and layout. So I've tried to spend some time and also tried to get some help from AI to restructure some parts of the supplement. So I'll be really interested to hear what you think. If you leave me something in the comments around that, I would really appreciate it. So that's from the macro section onwards. I always really value everybody's feedback. I know lots of people aren't that keen on change, but I'm sure everybody listening will be up for change for the better, and that's what I'm aiming for. So time for Trumponomics. We had the latest trade figures highlighting the fact that UK exports to the US had actually fallen in volume terms to their lowest level since January 2022. Why? Tariffs, simple as that. Not unexpected, but also don't look past the JLR cyber attack, because we do export a lot of Range Rovers to the US. And remember, it impacted the whole of the UK economy as a shock to the whole supply chain in JLR, and directly affected those exports as well. So maybe don't throw the baby too far out with the bathwater on that one. More of a tariff, more of a cyber attack effect than a tariff one, really, I think. But as far as pharma goes, some of the expected negotiations didn't go the UK's way this week. And NICE, the National Institute for Clinical Excellence, who make probably the least well-named organisation ever, because everything they do is not nice at all, have to make those really difficult decisions like they had recently around prostate cancer and screening and testing, and see what would do more harm than good, and ultimately what offers good economic value, which is what has to be done. You wouldn't believe that if you heard some people criticise the NHS, but it is ultimately the truth, because it is a huge spend, heading towards $250 billion a year by the end of this decade, and therefore they're pretty tight on that sort of stuff, as you can imagine. But Donald Trump's had this big beef, thinks we're not paying enough for our drugs. They're doing all the hard work. We're getting stuff on the cheap. We just don't pay the sort of prices the Americans do and the American insurance companies do. But of course, it's a completely different business model as well. So there's an element of truth to what he's saying, but ultimately you've got to be quite careful on that front in terms of what we see and what we get. So the 100% tariff threat is still there. But the UK counter is we want to pay no tariffs at all. And ultimately what's ended up happening since I wrote this at the weekend is that effectively there isn't going to be a tariff levied, but we will look at paying 25% more on our cost effectiveness threshold for the right sorts of entrepreneurially created drugs. I'm sure we'd be very keen to point out that's not just a 25% cost rise across the board from the NHS's budget, otherwise the budget is blown to bits, of course. But, you know, these 100% tariff threats keep coming up. It's the way Mr. Trump negotiates. Pretty straightforward, really, to be honest. Let's play off the tariff versus the outcome that he wanted, which is ultimately more money for US companies. Now, he also continued his mission for world peace. He rolled out that plan to basically give East Ukraine to Russia as a reward for their incursion. I would say here, we don't negotiate with terrorists, but we do every single time. And often the terrorists are quite effective, it would seem. You show me the incentive and I'll show you the outcome. Europe have countered, of course, with a completely different plan, which of course has upset Mr. Trump. He's racking up the wars that he's solved, even though he can't even remember which countries between which he solved them. But that's where he is. But thanks were given in the US, Thanksgiving week, of course, so markets were very quiet after our budget. But overall, the bond markets pretty much seem to like Rachel Reeves's extended headroom, apart from anything else. The media aren't saying it much, but actually the markets don't mind Rachel Reeves at all. They're pretty comfortable that she's pretty middle of the road, pretty steady. Not that she's necessarily doing the right things from an ideological perspective, from a capitalist perspective, but she's not as incapable as some chancellors we've had in the recent past, without needing to name anybody in particular. Then the US ranchers describe themselves as feeling economic whiplash. Sounds painful, doesn't it, from all the policy changes? But of course, there have been over 100 changes to tariffs in the US this year. So surprisingly, it makes business planning pretty difficult for anybody involved in producing or importing anything in the States. Instability, right, regardless of tariff outcome conversations. And of course, US inflation is still persisting in the figures, not according to Mr. Trump, but in terms of the real figures on the ground. Of course, tariffs have also been inflationary. He also had an 11 out of 10 phone call with President Xi, who apparently agreed to escalate purchases of US goods when he was on that phone call. It was a little more than half a week, thanks to Thanksgiving in the US, so I'm going to leave it there and come back to Blighty and the real-time property market. Chris Watkin delivering one more time in a big week 46. That means there's only 6 weeks to go. Listings printed 24,700, down 1,400 on the week. No one's ever surprised when it slows down at this time of year. Although what we're going to see after the budget should be quite interesting when we see those figures finally drop through. The average week 46 sees 26,900 listed. So we're well below that, 2,200, below the average week 46. We're listing fewer and fewer, but it was the build up to the budget. So I'm sure people were waiting to see what happened. I've certainly seen in our own group a few bits that we've got on the market. We've agreed 3 sales this week, and it's not like we've got tons and tons on the market. We've got about 15 to 20 units on the market around the country, but still 3 sales in a week. All, I should say, after budget day, when people had that certainty. And that was a key factor, right? Still a slow process, though. There'll be a listings clear out at the end of the year and the usual Boxing Day action. I actually had an excited phone call from Chris Watkin after writing the supplement before recording this, which was telling me that there'd been an awful lot of stuff on the market in London go on at over and between sort of $1 million and $1.5 million, or even up to about 1.7, 1.8, as they've escaped the mansion tax. And there is this potential theory that perhaps that bit of the market will do quite well, whereas at 2 million and above, things will struggle a little bit as people don't really seek to take on yet another extra payment, extra tax. It might sound silly at £2 million house cost, but it depends how much you're borrowing, doesn't it? Depends what your deposit is, depends on all the rest of it. But I think we can really safely conclude now anyway that listing over performance is over as a rule, as a trend, even if there is a little spike after the budget. And so this will all drop out the figures in about 9 or 10 months time. So it will drop out the year-on-year data, what we call the base effects. But my ready reckoner of 10% more stock than a normal market is still holding up, because we've had nearly 2 years of overperformance in listings now compared to historical averages, and only had 2 or 3 months where we've crept back towards those averages. 1.61 million homes listed this year so far, 8.2% ahead of the 9-year average, although that does include 2020. We didn't list that many homes, although we did recover quite well actually in the end, so it's not too bad at this point in time. And coming back towards the 2024 numbers, we were 6 to 7% ahead of them at one point during the year, and we're now only 0.8% ahead, so a big difference, but 8.4 ahead of the pre-pandemic market. Historically, week 46 is not a special one, but we listed 14.9% fewer homes than week 46 of last year. So it looked a lot like a fairly quiet pre-pandemic week 46. Now, there's enough time left actually for it to be a close one between 25 and 24 for listings. But if a fair few did hold off because of the budget, will they sort of press on and 2025 just get its nose in front? It's going to be very, very close in the end. There's about 13,000 listings in it at the moment, and we'll see what happens ultimately. But will 2024 stay as the listings king for the decade, or will 2025 take it? We'll find out. Price reductions, 13,400, so another shift downwards in price reductions But estate agents knew that this isn't really the time for reduction. Save it for Boxing Day, save it for the new year, or if the vendor's unrealistic, whap it off the market. You've given it a go. It's not going to happen. October saw 12.8% of stock reduced. September was 14.1, August 11.1, June and July 14.1 and 14 respectively. Average for the year 13.2, 5-year average 10.7. So there's still 25% more reduction than the average over the 5-year market. So plenty of reductions still been going on, plenty of reduced stock still on the market sitting, because you're seeing lots and lots, you're seeing sort of 6,000, 7,000 reductions in a couple of days. So you're seeing nearly 100,000 reductions in a month, realistically, big numbers. The market is really just heading towards normalisation though, fewer listings and fewer reductions now. So we're heading towards a bit of a balance and maybe heading towards a bit of a more exciting market for 2026. But I won't spoil the forecasts just yet because we're not there yet on that one. 23% more reductions than the 5-year average, 25% more reduced than the Ready Reckoner, more like 33% more reduced stock on the market. But as I say, it will start to come back now. So my 25% general stab will hold up for another few months, I think. 20,900 sold subject to contract, healthy enough, but 2,000 down on the week before. 2025 average 26,000, but the week 46 average 21,400. So 500 homes fewer than the 9-year average, a couple of percentage points below. Not a huge deal, I don't think. Sold subjects up 3.4 year on year and 12.2 up on the pre-pandemic market. And they will stay ahead of 2022 because we've passed the day of the lettuce. We're into the aftermath territory. And sold subjects up 3.4, but listings only up 0.8. There's more volume, there's more intention to transact than 12 months ago, and that will be the case for 2025. A better year than 2024. Not necessarily for pricing, because apart from anything else, London and the South East is now really dragging things down and has actually gone backwards in the past 12 months, even in spite of inflation, wage increases and the likes. London is festering on, really, with its very difficult investment market that makes it very difficult unless you're sitting on an awful lot of cash and you really, really like property. Because even if you've got an unencumbered portfolio, you might be deciding to put your money into 30-year bonds at the moment, for example, if they're no effort, 5% and above returns. Who knows? But there's very little incentive for further property investments, let's face it. Unless you could buy really well, in which case there's always an incentive for further property investments. But there we go. Second best year for 9 years behind 2021 for gross sales. And week 46 was reasonably buoyant. It's considerably better than week 46 of 2022, which was mortal, and also 2017 and 2018. So I think 2025 is second place for the decade in gross sales. That much is safe now. There's still this anomaly I really wanted to report on, the average asking price of the listings, because people have not been putting expensive stuff on the market. Average, I mean, I say expensive, throwing these numbers around, obviously, 394,000, but that is low, especially compared to higher numbers that were coming out in months like September. Average price of sold subjects 352k, an 11.8% difference. The 9-year average is 16 to 17%, which is pretty seismic. But I do expect once there's clarity after this budget, now this is going to right itself. And as I've said, Chris has already given me the heads up that we are going to see that in the figures. It won't be in this following week's supplement because he runs a week behind. It'll be in the week afters ultimately where we'll really see it. Although there will be a little flutter in this week's figures when they come out because budget was last week now, of course. So 452k average listing price September, 415 in October, and dropping to 394. So dropped like a stone, really. There's always high listing prices in September, so don't read too much into that after the summer holidays. What will happen for the houses over 2 million quid? Let's see. There's knee-jerk reactions, and then there's where the market settles. People aren't going to be silly about it, I don't think. So November's entry point, 1st of November, we had 742,072 homes on the market. That was down from October's number of 751,797, and that was down from August's peak of 763k. So it does look like 763 on the market is pretty much the peak now, and we're heading back under 700,000 as this market warms up. But it could take us 6 months to get there. It could take us 3 or 4 months. Let's see how much is listed in January. We may just see a renewed wave of selling, of course, because of things like renters' rights and all the rest of it. So per square foot, sales agreed, average October £343.18. Still hasn't got back to June's number of 346.45, but it was a big improvement on September's number of £336.54. So Chris has been telling me this has actually been creeping up even more, and the reason for that is selling smaller houses which tend to achieve better prices per square foot. The marginal square footage after sort of 90, 100, 110 square meters, or 1100 square foot or whatever, tends to go down fairly rapidly. So we're not back to June or July, but it looks like a bigger than usual summer adjustment, and we're nearly back there, in short. Fall throughs pulled back to 24.7 from 25.4, long-term average 24.2, so very close to that. Net sales were a bit weak, really, 15.7%, but still 3% up on last year to date, and 9.1 higher than 2017 to 19. So now above 2022 levels, more than 35,000 net sales in front now of 2022. But week 46 9-year average, 15,900. So 15,700, not a material difference at all. Now, Chris always gets his weekly shout out from me because he's much more prolific than just this epic tome he releases every week on the UK property market. Great stats on a regular basis. Drop him a like, a subscribe, and all the rest of it, and some kind words for his content creation. If you're in the industry and want support in growing your business and to be a more effective communicator, be more in touch with your local market, that's his core business, so give him a shout. His articles published on the Property Industry Eye website and the video on his YouTube channel, which is at Christopher Watkin. Okay, so what's in this week's macro? Well, I can't not comment on the major revisions in the net migration figures, especially as I made such a strong case for a growing rental demand in the UK over the past years during the Boris wave. The data is the opposite. Zoopla released their house price report, which gets some deserved airtime. I'm also going to look at the Scottish stats on rents and landlords, and then in the final slots, gilts and swaps to round us up. You know it. Just one stop right there stat that I wanted to share as well right now. The ONS published that there were 93,823,780 guest nights spent in short-term lets in the UK from July 24 to June 25. No wonder they want a piece of it, eh? Anyway, migration. It was a big surprise to see quite such a big drop, mostly revised, we were told in the media, due to a much larger number of British nationals leaving the country in the year to June 2025. But here's what I made of that report and that claim. Well, we need a quick deep dive into the underlying mechanisms that caused the dramatic 2/3 reduction in long-term net migration from 649,000 to a provisional 204,000 for the year ending June 2025. The explanation is fundamentally simple but structurally complex. It's a cynical consequence of targeted policy restrictions on immigration combined with the expected churn of previously particularly large cohorts leaving the UK. So the core mechanism, or the immigration collapse, well, the primary engine of net migration was the drastic decline in long-term immigration, which dropped by 401,000 over the year to 898,000. So this is policy tightening on dependents, right? Almost entirely attributed to fewer non-EU and beyond nationals arriving for work and study. So this was crucially to do with the policy reforms which were actually introduced in early 2024, which we knew one of the final things the Conservatives did before they blew that election. They targeted family migration of dependents. All this makes economic sense to anybody without getting into a migration argument about anything or anything particularly emotive about migration. Ultimately, we said you can't bring as many family members, dependents, and all the rest of it into the country if you're moving to the UK. There was a 70% drop, 70, in work and study dependent visas combined. Study dependents saw the most extreme fall, decreasing by about 85%. That's from 87,000 dependents of people coming to study down to 13,000 since the year that ended June 2024. Work dependents were down 65%. And that's how that sort of blended to 70%-ish as a drop in total. This included restricting care workers from bringing family members and increasing salary thresholds for those on skilled worker visas. You've got to be fairly liberal to try and have a go at that, I think, realistically. But from an economic perspective, it just makes sense, realistically. So what about the outflow? Because that's the secondary mechanism here. It compounded the sharp cut in immigration, continued gradual increase in long-term immigration, but gradual. Listen to the use of the word gradual. Provisional estimates showed emigration up by 43,000 to 693,000. So it wasn't this huge jump up. There was a huge revision in the numbers. That's a different matter because they started using a different way of measuring it, as in the actual number of people leaving and their I believe it's to do with their national insurance and their payroll, rather than using a survey, which is a pretty rubbish way to measure anything, let's face it. So the outflow is heavily driven again by non-EU nationals leaving, 286,000, and half of them who left originally arrived on study-related visas, so about 150,000 people, and that's the natural cycle. Massive numbers after the pandemic are leaving their studies and leaving the country. Not that many students came in the past, and anybody who's got student property knows that. That year was very tough for filling student rooms. People had to cut prices dramatically, and they had voids. So net migration plummeted because the government closed the door on new dependents, while the existing student cohorts continued to exit, resulting in the 2/3 reduction in the provisional figures. But I thought this was all about Brits leaving the country, wasn't it? And that hasn't featured at all in the ONS report, and perhaps we should be a little suspicious of that. So let's look. The media is fixated on the alleged wealth of departing British nationals, and the subsequent economic panic is a somewhat predictable and cynical response to the raw figures. While the source does not provide the necessary data to confirm their pecuniary status, there is definite merit in the underlying analysis that the outflow of British nationals is harmful to the UK economy. The raw numbers confirm the media's concern about scale. Long-term net migration for British nationals is provisionally estimated at negative 109,000 for the year ending June 2025. So significantly more British nationals left than arrived / came back from expatriate placements abroad, for example. So there's definitely some merit in the underlying analysis that the outflow of British nationals is harmful to the British economy, because ultimately the people who are willing to move country are probably the people who've got the most get up and go, apart from anything else, let's face it. But so we've got a little bit of concern about the scale of that, definitely. Their wealth, not so sure. I think it's a relatively reasonable spread across the board. But ultimately, if you're completely skint and you're on benefits, you probably don't leave the UK. So it's not going to be the bottom 10 or 20% of income earners. We can be reasonably safe on that. But of course, it does also then depend on how much that people are considering using, are they taking dependents with them? For example, if you're moving to Australia, you might be taking 7 or 8 people who are out of the country with you. You never know, right? So the factual drain on the economy, the key data confirming the damage, regardless of their supposed wealth, is the demographic composition. And this is something we know for a fact, so this is important. 91% of British nationals who left the UK for the long term in the year that ended March 2025 were of working age, so between 16 and 64. So only around 8% were children, and fewer than 1% were over 65. So this outflow represents a direct and quantifiable drain on the UK's productive capacity and our human capital. So there's a macro ceiling to this. We don't want to be losing 91% of the people who are leaving the country being of working age, right? That's nothing like the demographic pyramid, nothing like it looks like. There's nowhere near. It's more like over 25% are over 65. So problematic if they're leaving and not picking up the tab for the pensions of the people that are left behind. But as previously noted, if you drastically reduce the supply of working age individuals, whether through policy-induced immigration cuts or native immigration, it places a firm ceiling on potential GDP trajectory because it limits the available labour pool. Losing 250,000 working age people, particularly if they're skilled, only exacerbates the challenge of replacing lost capacity with productivity improvements. Now, what about the wealth speculation and the reality? We don't have the data on their net worth. Exclusively the wealthiest people, it's just not going to be true. It's conjecture. But 91% working age individuals, whichever way you look at it, strips the tax base, and it heightens the risk of rebottlenecking key sectors that are already constrained by reduced immigration inflow. And look, like I said, they're at least wealthy enough to leave the country. In many in their favoured destinations, you do need some skills and you also need some savings. Otherwise, you're not going to get a visa. So little note on the data's reliability, because you can't do anything at the ONS these days without noting that. It's crucial to remember that the current numbers for British emigration have got these new methods using RAPID, the Registration and Population Interaction Database. We used to use an international passenger survey which undercovered this nationality group. So obviously they're going to destinations where we're not picking them up with the survey, but we are seeing it happen. So This level of British emigration is not an entirely new phenomenon, but it is a more accurately measured crisis. We'd have to go back for many years and see if we can use this rapid data to see how long this problem has been going on for at this level, rather than worry too much about one revision. Loss of 91% of working age citizens confirms that the economic harm is inherent in the demographics of this outflow. Doesn't really matter if they own a second yacht or not, so we just got to watch it carefully. But tune into talk radio and you hear many stories of the brightest and the best graduates leaving in order to pursue a better life abroad, and they're quite often encouraged to do so by mum and dad, aside from anything else, who are sitting there saying there's no future in the UK and all the rest of it. Personally, I don't agree, but there we go. So, moving on to Zoopla and the house price index for November 2025. I was very pleased when I saw in the week that Richard Donald, the exec director of research, shared it online and spoke of a rebound in the market, as I've been saying something similar for the past month or so, after that budget fever really kicked in. It confirms the UK housing market is stubbornly resistant, it prefers to say, to a rapid correction, although deep regional and asset class divergence is setting in. Posh way of saying that expensive houses aren't doing so well and cheap houses are doing well. So a little bit of levelling up there, I suppose, is one way you could look at it. And the budget, while it offers clarity to the political acolytes, doesn't address the fundamental affordability crisis that Zoopla still maintain that we have. I remain to be unconvinced of that, to be honest with you. But then we've got an affordability of roof over the head crisis, if you want to talk about it, because really the relevant thing is the comparative cost of rent to mortgages. But of course, as I say all the time, when you own a house, you don't just have to pay the mortgage, you've got to pay the insurance, you've got to sort all the stuff out, the maintenance and all the rest of it yourselves. And usually when you own a house, you like to spend money on improvements. So it costs you an awful lot more than paying rent. But anyway, their headline figure shows the average UK house price, £270,200 as of October 25, annual rise of 1.3, marginal gain slightly softer than the 1.7 that they recorded the previous year, which proves the market's resilience. But under the hood, they talk about a stark bifurcation, regional divergence, as I've said, up 3% in the northwest, 2 or 3% across northern England, Scotland and Wales, flat down south in London, etc. And then the activity slowdown, because it came early, the seasonal dip, mostly because of the budget, we've speculated, but buyer demand 12% below last autumn. And whilst the committed buyers are pressing on, sales agreed 4% lower than a year ago. Now, I've already explained, we got into this stage, didn't we, where you have to remember in context. September 2024, we had the first rate cut. It started to pick things up, pick things along. Most of the intelligent commentary at the time was saying, look, 5-year rates aren't going to go down an awful lot more than this, so you might as well get on with it. And it gave people that bit of confidence to start transacting in more volume again. So 2024 ended up being a pretty good last 4 months of the year, which led us into an okay 2025 for transaction volume. We're not necessarily talking about price movements here, but we're talking about volumes of transactions. So very normal, the market from a volume of transactions territory. And then GDP and confidence, well, this new annual property tax, which is hanging over about 210,000 homes that were on the market, everything 500 grand and above, removed a big constraint in higher value areas. And like I said, that's already played out in some parts of London. Sub 2 million, sub 1.7, 1.8 million, happy days. 2 million plus, sad days, apart from anything else. So what about the real estate implications? Well, dictated less by the broad economic health, according to Zoopla, and more by unreformed tax policy and, as they've said, affordability constraints. So fiscal drag is a huge problem here, right? These frozen tax thresholds are stopping people from being able to afford more because so many more people being dragged into the higher rate threshold. Average first time buyer already earns 60k. They're going to get increases. So more of their income from a percentage perspective will be taxed at 42% if they're on PAYE, 40 income plus 2 NI. What about landlord and developer confidence? Well, it's helped by the removal of speculation, but the obstructive regulations are still there that are stopping lots of developments. Landlord sentiment is pretty poor, high debt costs, RRA, all the rest of it, EPC stuff hanging over people's heads. But do they see this cancellation of a tax over 500 grand? I haven't seen the government communicating on this very well. Surprise, surprise, because I don't see them communicating very well on anything that they do. A bit of a shame there. And then the price outlook, well, Zoopla say neutral to slightly bearish for high volume, low value entry points, and slow bullish for higher value southern stock post budget. disagree with them altogether, to be honest with you. I don't see why the high volume, lower value stuff won't continue to do quite well, and I don't see why the expensive stuff won't continue to struggle. But perhaps if we get the rates down another 2 or 3 times over the course of the next 12 or 13 months, perhaps that will indeed increase confidence. I don't think it will affect the 5-year bond yield very much myself, but I love to be wrong in these situations because it means debt's cheaper for me, apart from anything else. And then what about the hidden detail? Well, people are overlooking the entry point problems on the property ladder. You know, flats and maisonettes declining by 1.1% in the year to October 2025, according to Zoopla, the only property type seeing negative annual growth. And it matters because it's what first-time buyers and investors do, generally speaking. I mean, flats are really, really struggling at the moment. Even with first-time buyer levels, more than half of first-time buyers in southern England and 80% in London now pay stamp duty, despite the stamp duty holidays. The market's now demonstrating it will not tolerate price rises in the most affordable segments, whereas the cost of debt and taxation, while the cost of debt and taxation remains this high, we'll see. Listing prices are pretty static, as I've said, but Zoopla think buckle up for a period of painful stagnation in city centre entry markets, which I would agree with. That looks endless, to be honest with you, because service charges are too high. Developed flats were overpriced in the first place. I could give you a million more reasons, to be honest. And then in Scotland, where we've refused to learn lessons from their withdrawal of Section 33, which was our Section 21 equivalent north of the border. What about the Scottish rent shock then that's been going on? So what's been going on? Well, they've released some data, rent statistics for the year ending September 2025. They're saying affordability's hit a brick wall in key urban areas, but inflationary pressure has shifted violently to peripheral markets. Sounds aggressive, doesn't it? So the 2-bedroom flat, this is the yardstick in Scotland. Lots of 2-bedroom flats, not the same stigma in flats in Scotland as in England, not the same outrageous service charges, normally speaking, and not the same leasehold depreciating value problems that exist. It compares pretty favourably, their 3.1% rent rise, to a lot of the rest of the UK and to the UK CPI, which was 3.8 for the same period. But it masks a huge divergence according to the data. So 1-bedroom shared properties, 5.5% up on rent. 1-bedroom properties in general up by 4%. 4-bedroom properties rent down by an average of 1.5%. So a flight from higher cost or non-urban family accommodation. Major economic centres are decelerating sharply. So Lothian, the highest rents, includes Edinburgh, of course. 2-bed average £1,356, so chunky. 2-bed rent growth minus 0.1%. 3-bed rents down 5.5% in Lothian. So they think maximum affordability has been reached, and you have to see the point there. Household budgets are fully exhausted. But smaller BRMAs, broader rental market areas, Dumfries and Galloway, 12.7% up on 2-bedroom units. And the overall health of the economy, as evidenced by this report, is highly fractured, with inflationary pressure relocating to the lower end of the housing spectrum due to chronic supply shortage. So, translating this structural stress into UK residential property impacts is fairly straightforward for buy-to-let. Landlord sentiment, rent growth in your Lothians and your Dundees and your high-value areas, a dire signal for landlord cash flow. New mortgage debt expectations, 5.6-ish, something like that. You need 7% yields for debt service cover, and you won't make any money at 7%, especially if you're using an agent. Flat or negative growth in prime markets, so why would you invest in buy-to-let? Deeply, deeply unattractive, unless, like I say, you're getting a great deal on the way in. What about mortgage affordability? Well, big growth rate for shared units, so housing costs will be a big driver, potentially contributing to the Bank of England maintaining defensive posture against cutting rates. Not so sure about that, really. It does look shoe-in now that rates will be cut on December the 18th. But of course, we'll find out, and you'll find out here what I think about the whole thing. It's bearish data for house prices in investment-heavy urban centres, and the loss of profitability drives landlord sentiment towards liquidation, potentially increasing the level of stock on the market and exacerbating the affordability crisis by further depressing the supply of rental units. Flats stay flat, leasehold or not. What about what everybody else missed? Because that's what I'm always looking for. This is advertised rents, right? I always stay the same. The PRS is still a little bit larger than it was in 2022, at the very start of 2022. 349,075 registered properties in September 2025. The cost of entry for new tenants is probably reaching its practical limit in these expensive markets, but the decline in the 4-bed segment is suggesting the market is not even tolerating price maintenance at the higher value end. So it matters because the economic squeeze directly translates into diminished revenue potential for any new or remortgaging landlords. So lack of appropriate returns on capex, compounded by high interest rates, housing starts remain in an ugly state, and the supply crunch, which is the true driver of long-term rent growth, 66.3% up cumulatively on 2-bed properties since 2010 in Scotland, will not abate. So continued rental market instability in Scotland is pretty much guaranteed. So is it fair to say this landlord exodus is not just anecdotal, it's statistically verifiable? Have we been past the peak of the market inventory? Well, the peak was 350,129 September 2024. We're back to 349,817 registered, so only 300 properties off. So we're flat, aren't we, realistically? Structurally high, but flat, and it does look like the peak has passed, but we might get back there. The Scottish Housing Survey, which is how they used to do it before the registration, the old money estimate was 340,000 rental households in 2019. So many more rentals per capita because the population of Scotland has grown since then. Scottish Household Survey estimate for 2022 was 320,000. But like I said, these surveys are nowhere near as good as actually measuring things like how many landlords are registered. There will, of course, still be landlords who aren't registered as well. Some of that will be nefarious. Some of that will be utter ignorance in more rural Scotland. I don't doubt it for a second. Number of individual landlords, though, how about that? Well, there were 239,566 in January 2022. That number has fallen fairly substantially, down over 7,000 landlords. The number's now 232,396. So if you think we've moved up fairly significantly from Jan 2022 number in terms of units, but down significantly in number of landlords, this is the hard evidence you were looking for. Market liquidation, consolidation of asset owners. So the structural contained that registrations last for 3 years. So there's a known time lag in deregistering properties, which now takes on an even more cynical light. If you know the number of landlords is falling, the true loss of available rental stock is likely underreported by the current property register figures. The real number of available units is much smaller. Then the market is shedding capital providers at a measurable rate, suggesting that investment profitability, already crippled by high debt expectations, has collapsed, which will only exacerbate the chronic supply crisis and future rental inflation. Let's go to the calm of the gilts and swaps then. It's dangerous to read too much into this week for reasons already stated. Thanksgiving meant very light activity from the US, so we really need to see this coming week if we've had the message we think we have from abroad, relative green light. Things are okay in the bond markets. JP announced a £10 billion tower. It wasn't the first time that had been talked about in the city, on, off, but it did sound like a resounding vote of confidence after the budget. Goldman's doubling their Birmingham workforce, also news that was released, I'm sure strategically, on the afternoon after the budget. So a pretty limp budget and then some positive announcements on that front. 5-year gilt opened the week at 3.955, closed at 3.898. It was volatile on Wednesday, especially when we saw the OBR take on the budget, when they accidentally or whatever leaked that report even before Rachel Reeves has had a chance to start her speech. But the swings weren't that outrageous and things calmed down by the end of the day, unlike, for example, the Kamikaze budget of 2022. So nearly 6 basis points off the yield. I always cite these sort of weeks as my favourite weeks. Thursday's close around 3.91, translated to a swap of 3.585 being the last traded. That discount narrowed slightly to 32.5 basis points, and I'll continue to keep an eye on that. What about the longs? Opened at 5.354, 30-year gilt closed out at 5.189, big drop of 16.5 bips as the yield curve really did get a fair bit shallower. The budget was the driver, and insanity level 30-year yields are perhaps behind us for a bit, until the next time, maybe. At the end of this week, that was all translating into the cheapest limited company mortgage offering for rental being 5.25 with 0 fee. That margin looks skinny compared to the cost of debt, so your tight margins are being replicated by the lenders too, it seems. Okay, safe for the deep dive. I analysed the budget, the whole thing live actually on the Propenomix YouTube channel. And there is a link to that video in the supplement if you want to look it up on LinkedIn. 2,500 people who had a look at some point during the day on all of that. And the YouTube comments were good fun, but then they always are. So rather than rehash it all, I thought post-mortem number one, likely to be some more next week, of course, I'd look at the output from two different sides of the fence. Although both these sides of the fence are pretty sensible, fairly central and pretty pragmatic, to be honest. The IFS, Institute for Fiscal Studies, known to lean a little bit right. And then the Resolution Foundation, whose ex-CEO, Torsten Bell, the MP for Swansea West, has been credited for being a strong influence on the budget and is working within the Treasury with a fairly broad brief, as I understand it, as a junior minister. But this was all about the budget that was delivered last Wednesday. IFS first then, where did they land? Well, their initial response confirms what every seasoned macroeconomist already suspected, a cynical exercise in political optics. Immediate spending increases, backloading the pain to preserve the illusion of stability before an election. Spend now, pay later, as I said. I thought Helen Miller's quote was a worthwhile one this week. So it was not a grand tax reforming budget, but it was a sizable increase, 26 billion. Not sure of the previous year's 32 billion, although that was billed at 40. Of course, that was more of a net 32 after what the government was paying itself of the national insurance rise was taken off. And the puffery reminds me of American wrestling. The core economic trajectory set by this budget is defined by fiscal drag and future spending restraint, neither of which bodes well for unlocking meaningful growth or solving the UK's chronic structural housing shortages. So macroeconomic reality, spending now, paying later. The IFS confirmed that borrowing is actually set to be higher than previously forecast in the current year and in the years that are to come. Despite the highly publicised consolidation, total borrowing is expected to be a shocking £57 billion more over the 5 years to 2029-30 than we anticipated in March. And this fiscal consolidation is heavily backloaded, relying on tax rises and promises of spending restraint in the subsequent spending review to deliver lower borrowing only from 2029 to 30. The IFS is rightly sceptical. Nobody does this before an election, and I'd have to agree with them. It seems ridiculous. It's political cyanide going through with these proposed measures. But fortunately for Reeves, the OBR, the Office for Budget Responsibility, contained better news than feared in its forecast. There was this widely expected modest downgrade to the productivity growth forecast, but higher growth this year. So further expected inflation and stronger real wage growth pushed up tax receipts, largely offsetting increases in welfare caused by inflation. So this fiscal drag is having more impact than they thought it would, which is still not good for the pocket and the cost of living stuff. Still, the Chancellor faced a manageable £6 billion downgrade from forecast movements, a lot smaller than the ugly alternative. A key choice was the decision to spend more on welfare, most notably by scrapping the two-child limit for better universal credit, costing £3 billion per year by 2029-30, framed as one of the most cost-effective ways to address child poverty. Now, the government is also finally acknowledging the considerable spending pressures from rising special educational needs and disabilities cost, or SEND, which could add £6 billion per year of pressure by 28-29. Explicitly forecasting these pressures is welcomed by the IFS, and I would agree. So what about the tax burden, the fiscal drag? And it's a constraint on the property market apart from anything else. Overall tax burden climbed from 36.3 this year to 38.3 of GDP in 2030 to 31. So this parliament is cemented as the largest tax rising parliament since at least 1970. Largest single measure, another 3-year freeze in personal allowance thresholds and personal tax thresholds at the higher rate band and the additional band. It's going to raise 12.7 billion in the final year, the massive definition of fiscal drag. And the effect of the threshold freeze, which actually began in April 2022, is now forecast to increase the number of taxpayers by 5.2 million and the number of higher rate taxpayers by 4.8 million by 2030 to 31, the end of this forecast period. The IFS confirms that this approach clearly represents a tax rise on working people, which does breach the government's manifesto promise regarding national insurance thresholds and all the rest of it. So fiscal drag is a fundamental headwind for the property market. It's this affordability ceiling that I've already talked about, putting pressure on first-time buyers and all the rest of it. And it's an investment disincentive for investors. So if investors aren't in the market as much, they're not pushing the prices forward, aside from anything else. So potentially detrimental to supply in the buy-to-let sector. What about the cynical side of it? Well, people were hoping for comprehensive reforms. I said before the budget, it was never going to happen. This government are not reform style, and I don't mean big R reform, by the way. They're not keen on reform. They're tinkerers, they're tweakers, they're messers around, and half the time they bottle out of what they said they were going to do of what looked like a tiny tweak, really. They're still relying on the 1991 values for council tax because they're too scared to do a revaluation. And then they introduced this complicated bolt-on, the mansion tax, whatever you want to call it, the high value homes based on the current values. It's not the worst thing in the world. It's certainly progressive, but the design of the tax leaves much to be desired. And this is the sort of rubbish you end up with. The first year's worth of receipts of this tax will be spent in setting up the collection method for this tax. But that's how new taxes do tend to work. And this is all a corner that Rachel Reeves forced herself into. I mean, the Office for Tax Simplification, talking about tax fairness, talking about things like that, it's just impossible to assess really at a certain level. Even really intelligent tax commentators struggle to do that. So this lack of fundamental reform, like for example, addressing the distorting effects of stamp duty, still provides a constraint on transaction volumes, perpetuates the ugly stagnation in the mid to high value segments where moving house is fiscally punitive. And then there was this welcome step of introducing a per mile tax. I mean, welcomed by the IFS and the economists, by the way. Actually going to be the second biggest measure in the budget. It's going to raise 7 billion annually. So massive, 3p per mile. But the flat rate is being criticised. It doesn't reflect that driving at congested times imposes a much higher societal cost. Of course, unless they have all the data from your car, which will get the conspiracy theorists all worried apart from anything else, then they won't be able to do that sort of thing. And they're just going to do a fairly simple 3p a mile. Bit silly because 3p a mile in central London, where you're going to pay the congestion charge. So central London's maybe not fair, but certainly near a city centre in a Manchester or a Birmingham versus a drive through the countryside with no real traffic or significant impact on other road users. Different drive, different place. Potentially arguably unfair on people in rural places that have to commute fairly significant distances just to get to shops and things like that. But it is what it is. It's never going to be popular. It's effectively a step towards road pricing. We hate paying for roads. We don't pay the fair price for using cars and roads in the UK. We never have done. And let's face it, we probably never will do. The IFS underlines a budget really that prioritises short-term stability over long-term structural health. The increased headroom is sensible, welcomed by the IFS for providing greater insulation against economic turbulence. But the credibility of the entire fiscal plan, relying on promises of future restraint to deliver lower borrowing in 29-30, is highly suspect. The economic consequences for the property market are clear. Fiscal drag of frozen thresholds, as I said, suppressing affordability, weakening incentives to save, and weakening incentives to invest. And buy-to-let will stay probably in largely liquidation mode. You may still see, of course, a lot of stock being picked up by the bigger corporates, by the investment houses, by money coming into the market. But I think you're still going to see probably net value destruction of buy-to-let units over the next 12 months on the back of this. And the IFS thinks it's just ongoing market stagnation. Growth will still struggle. And then a highly questionable political promise of austerity just before the next election. Have to agree with them. It doesn't look very politically likely to me. But let's move on to ResF, the Resolution Foundation's assessment. Similarly cynical, to be honest with you. Politically expedient front-loaded spending spree, they called it, built on back-loaded fiscal tightening. So she squeaked over the immediate fiscal hurdle, but the plan for future redemption is protracted, uncertain, relying on promises of restraint that are highly suspect before an election. The budget is not an escape route, they said. It's a stairway to fiscal headroom, paved with tax increases that act as a permanent ceiling on macroeconomic potential and household affordability. More simply put, you don't tax your way to growth, folks, and we kind of knew that, right? You can tax it and spend it and get growth through government spending, but ultimately, rarely does that provide enough return on investment to truly create what we need, which is a bigger economy. So what's the data synthesis? What were the macro signals? An ugly downgrade, they called it. Medium-term productivity growth rate down to 1% a year from 1.3. Significantly lower progress, 27% cut at the end of the day. Really significant. But I've argued many times we're not spending the appropriate amount of time, effort and money on increasing productivity in the UK. What about tax-rich offset? Well, luckily, this was pretty much offset by much higher tax threshold, tax take than was thought in the forecasts because inflation was higher, because wages stayed higher than forecasts. I said all these forecasts from the OBR were nonsense when they came out in 2024, and so it was proven to be true. But there we go. So average earnings growth between 2024 and 2029 is now raised from 14.1 to 15.9. CPI, they've got a 12.6 over the same period instead of 11.8. Still looks a bit low to me, to be honest with you. That probably is about 2.4 average per year. And of course, we've already had 2024 and 2025, which have been significantly above that sort of number. Although 2024 wasn't too bad in the end. Started at about 4, dipped to about 1.7, ended up at about 2.4, I think it was. But this year has been a little higher as we carried on after the employers' national insurance shock that Rachel Reeves delivered to us in the 2024 budget. But intrinsically, this is a tax-rich economy, so a boost in receipts of 14 billion a year by 2029-30. And then the debt drag, what about that? 5.5 billion more spent in borrowing than thought. The overall picture they describe at the Resolution Foundation as cavalier, higher in the March forecast every year until 2029-30 now in terms of borrowing. 4.7% average pay rate on 10-year government debt now these days, up from 4.5 in March. But of course the bond yields did calm down a little bit, so this should get better, hopefully, as time goes on. Although we've got a problem on the longer term bond yields, gilt yields, as I've been talking about for some time as well. Stagnation in living standards, this is the one that the ResF really get their teeth into. They look at RHDI, I like the metric, real household disposable income, forecast to grow more slowly this parliament than any other period on record, apart from the last one. But they did have a pandemic to deal with, folks, right? So RHDI per person forecast to grow by 0.5% a year on average by the end of the parliament, cementing the status of this parliament as the second worst parliament for income growth on record. What about if we look at it through a property lens? Well, bearish for property volume and investor sentiment, you would think. Temporary modest relief to affordability pressures. So affordability, mortgage rates, all this 12.7 billion extra that's going to be raised comes out of the people's pockets, doesn't go into houses at the end of the day, does it? Because they've already spent it. So it's quite disinflationary, actually, to be honest with you. Doesn't help in the cost of living side of things either. What about landlord sentiment with this 2% rise on income tax rates, on dividends? Obviously, that hits everybody. So if you think Section 24 only hit circa 50% of the rental stock in existence, because some people were already in limited companies, and then some people owned in personal name, but they were unencumbered, or they made themselves unencumbered after Section 24 because they thought, well, I'm not paying that. So they weren't touched by Section 24, but they did benefit from increased market rents. Whereas now they're absolutely touched by this, because you can't get away from this if you're making money in property. If you're doing it in your own name, you absolutely can't get away with it. If you're doing it within a limited company, you only pay it on dividend extraction, so you can still use that money and roll it up within the company. So it doesn't change my investment strategy at all for what's wrapped in SPVs, because we tend to reinvest quite aggressively and very rarely withdraw through dividends. Quite often we're not making an accounting profit apart from anything else, because we're scaling so quickly that is burning money in debt interest apart from anything else as well. So it's the bias against employment income that the ResF pick up, and I've also got a significant problem with, really. Let me try and explain this to you apart from anything else. If you have a prolonged period of inflation, which obviously we've had, and you have a lot of index-linked benefits, which we do have in the UK, then as that continues to progress and progress and progress through the levels, ultimately the workers are getting hit harder because they got the fiscal drag from this threshold, and the benefit claimants are not being hit because they don't pay tax on what they receive in benefits. So they're net getting better off and better off and better off each year in comparison to being employed. And that is important, because it will be the driver for some people. Do I have to go to work? Not those who see work as a necessary and healthy part of life. Of course, that's not a huge percentage of people, but it does make a difference. And ultimately, if people feel they're being treated unfairly, it doesn't help their overall sentiment, it doesn't help their mental health, it doesn't help their happiness, it doesn't help how likely they are to vote for the Labour Party next time round either. So there we go. What about house prices and taxation? Well, they also obviously highlighted the mansion tax. ResF absolutely come out and say it's a welcome and progressive step, but they do also agree the design leaves a fair bit to be desired. They think high price homes will fall in value. I'm not convinced they're going to be more than 1 to 2% to come off these, to be honest with you. But they were already falling earlier this year. They were falling in London anyway. So how will we pass the effect of the mansion tax to what's already happened? Significantly lower effective tax rate on housing wealth compared to lower middle value property owners. Lack of fundamental reform to stamp duty ensures transaction volumes remain constrained in the core housing market. What about others have missed in the hidden detail? Well, backloaded pain, we've already mentioned. Increasing borrowing by $1 billion on average in the first 3 years. And then supposedly some savings of $24 billion on average in the final 2 years. So $77 billion of the extra tax raised over the 5-year period is due to arrive, that's 73% of it, $77 billion is going to arrive after April 2029. Well, is it? Why does it matter? Well, the thing is, Jeremy Hunt kind of started this because he kicked Payne into the next parliament, and already Rachel Reeves and Keir Starmer are hanging on for their dear lives anyway, so they might as well think, well, it might as well go into the next parliament. Even if Labour hang on, we're probably not going to be at the front of the Labour Party apart from anything else, so you would backload the Payne, and this is going to be the poison pills being left behind by the other parties. This is just going to become an ongoing thing because this is what happens. Show me the incentive, I'll show you the outcome. These are the rules of the game at the Office for Budgetary Responsibility, and that's the way things are going to roll. So, are we really going to see significant spending cuts and tax hikes just as the next election moves into sight? It's a protracted and uncertain play. It shouldn't have been done this way. It's absolutely typical. But as I said, stupid manifesto pledges, meaning it's led to all of this. Huge cuts to non-protected departments, government and local government and justice. You'll have heard the news about lack of jury trials and things like that. Got a bit more nuance to it, that argument, I think, because people are playing the system sometimes by selecting jury trials to know they get more time out on bail apart from anything else, and hang the cost to the system. And the cost is significant, of course. So, you know, criminal justice reform is something that happens all the time. There used to be trials for everything, jury trials for everything. So I'm not as negative as some are. Some are saying it's driving a truck through the system and all the rest of it. I don't know. We need more court space. I know that much because we're going to have more Section 8 notices to deal with. That's where I understand perhaps some resource to be made available. Well, this idea of 6.4 billion real terms cuts between 2028, 29 and 29, 30. This is 88% of the average annual cuts that were made during the peak austerity years, which is 2009-10 to 2018-19. So 88% of that sort of level of pain when people were screaming, and they're already screaming at the moment because of cost of living, apart from anything else. So what do ResF think? This is a deferral of the reckoning, as they refer to it. Immediate inflation relief might offer a transient opportunity for the Bank of England to cut rates, but there's still these structural constraints. Fiscal drag, persistent disincentive to property investment remaining in place, future austerity highly suspect. Market uncertainty is now therefore embedded in the long-term fiscal forecast. And ResF think there'll be continued stagnation, just like the IFS said, punctuated by political promises of pain, highly unlikely to be delivered. So where do the IFS see eye to eye with ResF, and where do they depart? Well, they both agree cynical, they both agree there's nuances of credibility, specific tax choices. My view is their analysis reveals that the budget's core mechanism is inherently detrimental to investment and affordability, regardless of which think tank you want to sign up with or which side of the political fence you're on. So the backloaded illusion is the phrase that we've come up with in order to describe that. So spend now, pay later, as I say, backloaded budget, we've said that already. Fiscal drag is king because of all this extra money that these frozen thresholds are going to gain. Headroom, 22 billion, that got a big tick from almost everybody involved. Sensible, providing insulation against future economic turbulence. So 22 billion extra headroom created, plus 4 billion left over from the 9.9 that was a headroom from last year. So she didn't have to move it, but if she got into the next year with no extra headroom on 4 billion, the bond yields would have been much, much more difficult to deal with. And then the property tax mess. Well, you know, they just added to the mess with the mansion. It's called the HVCTS, by the way, the High Value Council Tax Surcharge. As we've said, design leaves much to be desired. ResF say it's just an appendage to a discredited council tax. These think tanks are always going on about council tax, but they're correct. This is nonsense. Everyone's too scared to touch it because they still remember the poll tax in 1991, or at least they remember reading about it in the history books. So what about tax progressivity? Well, ResF had done a deeper dive into that. Less progressive than a direct income tax rate hike would have been, because 1p rise in income tax would have cost less for anyone earning under 35k, and that's the sort of group that ResF seeks to look after in their analysis. We already knew this. They both agree there's no appetite for reform. I've said this government is weak. Last government was weak. was weak. They don't have political will. They don't have gumption. They don't have courage. They just try and carry on and tweak things, little bits and bobs. Now, ResF thinks that the cost of living measures, including the energy discount, including the scrapping of eco, including the fuel duty freeze, suggests that the relief should give the Bank of England scope to bring forward one or more additional quarter-point rate cuts on interest rates, shaving half a percentage point off inflation in spring 2026, just with those cuts. I don't see how that adds up personally myself, because I think we're going to lose about 0.2 off the energy bills. The energy bill cut will be worth about 0.2. There are some base effects that are going to drop off, so perhaps they're talking about that 0.5%. We're pretty much guaranteed. Looks like we might get 0.5 to 0.75% off inflation around April 2026. But of course, we haven't seen the other rises yet, because remember, the minimum wage is going up 4.1, so that costs employers about 4.9% more, because ultimately they've got to consider on the marginal gain that everybody gets, there's full employers' national insurance contributions, there's full pension contributions, so that's why that cost is actually about 18% more than it looks like. That's the nature of minimum wage and how it works. Can the government deliver the promised 6.4 billion in real terms cuts to other departments, equivalent to 88% of the average annual cuts during peak austerity in 29-30? My view is very simple. It'd be completely incongruent with how they've acted so far. 88% would very soon be austerity mark 2. This is protracted, uncertain and likely to be abandoned. But what they both missed, the significant omission for the UK property market, is the deep-seated structural distortion between employed and self-employed income taxation. And it is the bias against employment is close to record highs, but neither report fully hammers home until this distortion is addressed. Labour market is structurally inefficient and capital formation for housing is hampered by punitive relative taxation. So my rant, the landlord style rant on this, the ugliest part is for buy-to-let is the 2% rise. Of course it is, in income tax rates on rental income, dividends and savings. If you've got debt of 5.6, you need 7% minimum yields. So much stuff out there won't be viable, especially in the south of the country, especially in more expensive areas. We're in a liquidation phase of the buy-to-let market at the moment. Units are going sideways or downwards. Realistically, nobody really talks about it. We're going to still rely on the English Housing Survey when that data is out this month. But it's a survey, and we've already discussed today a number of times how rubbish surveys can be in terms of how reliable or not that they are. So none of the real problems have been fixed, whether you prefer the IFS, when you put the IFS write-up, or whether you prefer the Resolution Foundation's write-up. No problems have been fixed, and we still are where we are. And they're not doing anything. They haven't done anything for Help to Buy. You know, they were said that Help to Buy was going to be something that was one of my tips. I was tipped off that was going to happen. It didn't happen, and the house builder shares went up like this in speculation before the morning of the budget, and down like this again when no Help to Buy was announced. They're just going to wait until the figures show, oh yeah, we're really not building 1.5 million homes, and then maybe they're going to do something about it. Or ideologically, they deeply disagree with Help to Buy, and this is a government that's led by ideology. You see that with things like what they did to the private school, VAT raids and things like that. Ultimately, they really do care about ideology, which doesn't drive the most efficient outcomes ultimately. So, as I draw this week to a close, our next property business workshop is filling up. Turning eyes to 2026, the tickets are available. Super early bird tickets at the moment for the rest of this month. But come Christmas time, we will be closing the super early bird. We'll start the year with a bang. We're discussing strategic planning, how to make the most of the next 12 months, some of our own methods and takes on productivity and time management alongside systems and processes. The other half of the workshop is about the most common pain point that we see in SME property businesses: accounts, bookkeeping, group accounting. This is about measuring asset performance. It's not how to use Xero, but how to make the most out of your financial information. What should you be seeing monthly, and how should you interpret it properly and use it strategically to grow your business safely but quickly? Super early bird tickets, genuine 20+% discount on the face value. We always have real life case studies about our own experiences, and we close with our no holds barred Q&A. Have you got something individual you'd like us to consider? Well, get yourself a VIP ticket, join us for dinner. It's a smaller setting with an opportunity to discuss any specific roadblocks or issues in your property business at the moment. That's the very best way to get a substantial conversation with myself and Rod and some other experienced property business people. So join us on Thursday, the 22nd of January 2026, Central London. Link down in the show notes, tinyurl.com/PBWNINE. But whatever you do, please remember to keep calm, always listen to the supplement and carry on. There are going to be opportunities abound over the next 12 months, and actually as we go towards 2030, this landscape is set for a surefire bull run in capital growth prices, especially on buy-to-let stock. It's just going to take a little time to get started, right? It's slowish, it's taking a little while to get off the ground, and the amount of stock around has been keeping things suppressed. But remember, at the moment, we're seeing less go on, we're seeing more being bought, and ultimately, the more that tips up, the more we'll go back to the lower number of houses and flats on the market, and things will continue to improve. If you knock out the flats, if you knock out the properties over 500k, the vanilla bread and butter sort of stock, the good honest yielding stuff that yields at 8% or above, is doing just fine and will do fine for all time. Because do you know what? However much AI, however much anything else there is, we're still going to need a roof over our heads. So thanks for tuning in, folks. I appreciate you. See you soon.